Okay, everybody out there in webinar land, it's Winston Stevenson here with Winston and Company's Retirement and Financial Services. It's 6 o'clock and we're going live with our webinar on income planning. I've got my green shirt on today because today is St. Patrick's Day. And so for those of you that ventured onto our webinar, we're awful proud to have you here instead of being in a bar somewhere. So this is a good thing. I see we got quite a few people on the call here or the webinar here. We got a few of our good friends tuning in from San Diego. It's good to see you guys joining us here. I see we've got Russ over in Texas on the call. New name, Mr. Harbin. Good to see you, sir. And I'm just going to give it a minute here. We usually get one or two or more people log into this, and then we will jump into it. And again, want to welcome you guys on the webinar tonight. So what we're going to do is just kind of have a little discussion about the number one concern of most Americans as they venture into retirement. Now, for all of you that are on the call that are already clients of ours, you're very familiar with our flight plan process. For those of you that are new potential clients, prospects, I hope you enjoy this webinar and find out that we do a very complete and thorough job with our planning. Now, one of the things I want to do is I want to recognize several of you that were on our webinar last week and thank you for the referrals that you sent us as a result of the webinar. We brought on board 3 brand new clients last week. And again, we want to thank our existing clients for those very kind referrals. There's no better pat on the back. There's no better way for an existing client to say that we're doing a good job than when they give us a referral. So again, I want to reach out and say thank you for doing that. So let's go ahead and get started here. I see we got pretty much everybody on the call that was expected. And again, I just want to point out, my name is Winston Stevenson, president of Winston and Company's Retirement and Financial Services. We got John Roller over here in the control room operating this event for us. And give a shout out to John for, ushering the people in that came in and reaching out to our existing clients. So AARP, American Association of Retired Persons, recently did a survey and concluded that almost half of Americans' number one fear as they go into retirement is that fear of outliving their money. All right, going broke in retirement. It's a scary thought. What could possibly contribute to that? Well, one of the biggest factors that we're seeing today is people are very concerned about living too long, running out of money. The brutal costs of long-term care. We had a client on at our 12 o'clock, if you want to call it broadcast webinar earlier today, where she shared a personal story through the chat. And, her mom lived to 97 years old, and there was a great deal of money spent on out of the estate that was benchmarked for the children through her trust that we put together. And, very touching story. So think about it. Living a long time, what are the things that can, obvious costs of living going up, but increased taxes and the threat of the cost of long-term care as we get older. So that is a very prevalent fear a lot of people have. And we like to address that story going into to this webinar on income planning and retirement with our little story about the 3-legged stool. Again, any of you that are existing clients of ours, you know the 3-legged stool pretty well. So I'm going to kind of address this to the new folks that are on the call today. The 3-legged stool is a story about understanding the shift in responsibility from your employer or your retirement plans that you're building money into as it relates to retirement income planning. That shift goes to that shift of responsibility moves from you as a saver, an investor, to you in retirement as a spender or a harvester of all that money that you've accumulated during your working years. So without ado, we'll jump into the 3-legged stool story. Here is a picture of the 3-legged stool that was. And most of you guys can relate, especially on a night like tonight, St. Patty's Day. So if you get off this call and you go out to a restaurant, to a bar, and you're sitting there Have you ever had that situation where you sat down on a stool where the leg was either too short, loose, ill-fitting, and it was uncomfortable because you sat there and rocked? And I remember earlier in my life when that would happen, we'd go up to the front where the receptionist was, or the whatever they call it, the hostess, and they used to always have matches, right? They were like little wedges, the match boxes and the little pads, and we'd get them and we'd slide them underneath the leg of the table, and it would stabilize things for the time that we were in the restaurant. But what I want you to think about is how annoying that can be, and whether or not you want to spend 20, 30 years in retirement sitting on a stool where one of the legs is too short or uneven or loose. It could be very annoying. So here at Winston and Company's Retirement and Financial Services, one of the things that we predicate our income planning model on with all people is to have at least 3 legs of guaranteed income. So when you look at the stool in front of you, the 3-legged stool, this is the stool that was, because most people, maybe it was your mother, maybe it was your father or grandparents, most people, as America was, growing up through the 150-year mark, the 200-year mark, most people retired with something called a defined benefit pension plan. That's represented on the left here. And a defined benefit pension plan was just that. Your employer put money into a plan, and when you retired, if you were single or married, you chose how you wanted to accept your pension in retirement. But it was a guaranteed paycheck, a paycheck for life that you could never outlive. And if you died, it went on to your spouse, depending on how you picked that. Most people today, over 60% of America today now, does not have a pension. And that 60% of people that don't have pensions is on the rise. More and more people will not have pensions, okay? So that's something to consider. Social Security. Now, Social Security is something that is always talked about. We had a Social Security seminar last week. The thing about Social Security is there's a lot of what we call water cooler talk. Oh, Social Security is going to go away. Oh, I want to take my Social Security before it goes away. Well, I'm going to tell you, if you're talking to a financial advisor and they're trying to get you fearful about Social Security going away, maybe you want to take a closer look at what we do here at Winston and Companies, because we don't spread that fear. We understand that Social Security is going to be there, just like it's been there for people for the last, 80 years. The fact of the matter is, my dad is a retired stockbroker. He's 89 years old now. And he told me when he started in the financial services industry back in the 50s that Social Security going away was always a scare. He says, it's not going to go away. But what's going to happen is it's going to morph. It's going to have many permutations. And that's why, as part of our flight plan, we really make sure people get logged into SSA.gov, get an account set up with Social Security, and track their Social Security, even if they're 5-10 years away from retirement, because it's so important that they understand Social Security and the changes as they come about. Last leg of the stool is personal savings. And you'll note there that it's referenced by 401ks, 403bs, and the like. Well, that money is now part of the 3-legged stool that is. So what happened with the 3-legged stool that is now is the pension, like I mentioned, went away for so many people, or is going away. And now we don't have a 3-legged stool to depend on like maybe your parents or grandparents did. What we have now is a 2-legged stool, which really isn't a stool at all, right? Maybe you got to have one arm on the wall to lean on to create that third leg. Well, the fact of the matter is, when we don't have a pension, that puts a lot more onus or responsibility on Social Security to provide for you, as well as your personal savings in a 401k, a 403b, 457 plan, TSP if you're a federal employee, that sort of thing. But the bottom line is you still need to create that third leg of income. So it's very important that you have a plan, a written plan. And I want to address your attention to the chat box. because John put into the chat box a link where you can click on that hyperlink and it will take you directly to our calendar, where we would encourage you to go to schedule a 15-minute visit, or if you'd like to schedule an in-office visit, we're happy to accommodate. But we really want you to talk to us about, what you're doing now, what your plans are. Tell us how we could optimally help you. Our flight plan is a very powerful, very encompassing program. I'll talk more about it here in just a minute. But as you move into retirement, the question is, where is your money? And how much of your retirement income are you willing to risk? Or put another way, how much of your retirement income do you want to risk? Now, it's very important to point out that just because you might be willing to tighten your belt in retirement, I'm sure most of you on the call, and I know a lot of you on this call, you don't want to know anything about tightening your belt when you get into retirement. You want to have retirement be a joyful time, a time in your life where you have the 3 phases of retirement. And when you go into retirement, you're in phase 1. Do you guys know? Well, I know all of our existing clients know the 3 phases of retirement, but for the new folks, we have a saying here at Winston & Companies that the 3 phases of retirement are the go-go years, the slow-go years, and the no-go years. And what we want to do is we want to be able to make all 3 of those phases of retirement functional for you. So just because you're willing to tighten your belt in retirement doesn't mean you want to. So what I want to do is I want you to take a piece of paper. Well, you don't have to do it because I'm going to kind of do it for you. Here it is. Take a piece of paper, lay it landscape. Draw a line down the middle, and you have right on the left side, principal protected assets and risk-based assets. Now, anytime you place money into basically one of these 2 categories, the first category that we would call the risk category is something that is what it sounds like. It's one of these things that when I say risk category, what does that word mean to you? Does that mean your money is guaranteed, or does that mean you could make money or you could lose money? Most people, when they hear that word risk, the first thing that come to mind is, what could I lose? And if that's you, then you're not really alone in that, okay? Now, over on the other side, we'd call this the principal protected category. And what's so important about the principal protected category is that there's really no risk to your principal or, from market loss, okay, like there would be in the risk category. But when it comes to risk, this is often thought of as the realm of Wall Street, okay? They manufacture a lot of these tools, these risk-based tools, and I want to show you what they are. Most people that have money in risk-based assets will find their money sitting in stocks, bonds, mutual funds, ETFs. Now, we do an awful lot of work here at Winston & Companies and are invested in our managed portfolios with exchange-traded funds because they're just a superior product to a mutual fund. I won't get into the details of that now, but if that's something that you're interested in learning more about, that is something we'll certainly talk to you about. In fact, that's one of the areas that when I mentioned the people had referred over some people to us from last week's webinar, they were very interested in learning about managed portfolios and ETFs. But nonetheless, that money still lives in the world of risk. It's in the stock market, REITs, limited partnerships, options, commodities, future, variable annuities, variable universal life insurance. So if you have any of these particular products, and that's what they are, they're products, you need to be mindful that these products in good times like we've had in the stock market, they can shine pretty well. They can make, upwards of 40% a year on your invested dollar. But at the same time, you must be mindful, because of that 4-letter word risk, that these can also go the other way. And right now, I just want you to ask yourself, where is the stock market today? Are we, in average area? Are we in all-time lows, or are we in all-time highs? So I'll answer that question for you. Right now, the Dow Jones Industrial Average, the S&P 500, NASDAQ, they're all in very high territory, okay? So what's the old saying with investing? Buy low and sell high. But what most Americans do that have money in retirement accounts is they tend to do what they always did. And that is leave the money in there, buy and hold. It's called strategic investing. And sometimes you need to think tactically. Sometimes you need to think about moving in and moving out, especially now if you're getting on the precipice of retirement and you've got a lot of money that's in the stock market and the stock market's very high. A wise tactical decision may be to divest some of that into something that's more principal protected, so it's there for you, when you need it the most. And that's what you built it for, is for your retirement income. So what's the market going to do? People ask me, is it going to go up? Is it going to go down? And I say, I don't know, because I really don't know. And here at Winston and Companies, we're not traders. We're not buying and selling stocks and bonds and stuff for you all the time. That's not our world. Our world is a world of more dedicated planning and setting up investment portfolios for the long run that can endure highs and lows. We don't know what the stock market's going to do. Only time will tell. On the other hand, I want you to look at the left side of the paper, the principal protected assets, and understand that there's a real battle that goes on in principal protected assets between liquidity and rate of return. What I mean by liquidity is if you don't put your money in something where the financial institution that's housing it can hold on to it and work with it for a period of time, you're not going to get much of a return. Let me give you probably the best example. Take a bank. If you put your money in a savings account, how much are you going to earn? Not much, right? And it's because it's completely free. It's completely liquid. So if the money is completely liquid, then you're not going to get much of a return. On the other hand, if you put the money in something like a certificate of deposit or a CD, and you agree with the financial institution to put the money in there for 6 months or 5 years even, what do you think is going to happen to the rate of return? It's going to go up. Okay. So liquidity has a direct measure on return. Let me give you some examples. Things like bank accounts, savings accounts, checking accounts, money market accounts. Well, we look into the government spectrum, T-bonds, savings bonds. Okay. The thing is that if you go to a bank account, if you earn 0.1% to 1.42%, you're really doing something in today's world. There's even talk about negative interest rates where the banks might actually charge you to keep your money in the bank. Government bonds, 10-year bond yielding a little over 2%, nothing to write home about, right? So what happens is savers, people who are moving away from risk, they don't have a very good place to put their money because these sources right here won't even keep up with inflation. And so we have to look at some other options. Excuse me. The allergies are bad out there, and I took an allergy pill, and it's making me very dry. So excuse me for getting a drink of water. We look at insurance companies' products, fixed annuities. Okay, a fixed annuity is kind of like a bank CD. You put your money in for a 5-year period, and you could expect to receive around 2.5% to 3% today on one of those. And now, what's nice about those is that they have triple compounding. Your principal earns interest, your interest earns interest, and the money you would have paid in taxes because you had received a 1099. You don't get that. So you have triple compounding on that money. Fixed indexed annuities. This is an area where we're seeing an awful lot of activity where people are moving money into these products called FIAs. They're usually a 10-year chassis. And that's fine because what happens is that these are products that are much more designed to give you market-like growth, okay? So if you have your money in a fixed index annuity and it's indexed to something like the S&P 500, the Morgan Stanley index, the Russell index, or maybe even we were looking at one today that's linked to the, gosh, I've drawn a blank here. What was it linked to? It was linked to the, it was the Russell 2000. So the bottom line is these can earn market-like returns, but your money can go up. They have a greater rate of return on them than what a bank or a government bond or even a fixed annuity. They can go up, but they won't go down. So each year when there's a profit made, you are locked in. Now, a lot of these things will come with caps or participation rates, which will limit. I'll give you an example. Say you have a participation rate of 80%, and the index that it's linked to is the S&P 500, and it goes up 10%, and you have an 80% par rate, you're only going to get 8%. That extra 2% does not go into your account, but it's credited at 8%, and it's locked in. It never can go away. Now, the reason why there's not 100% par is because in the event that the market loses 10, 20, 30%, what do you get credited? Zero. Okay, zero is your hero when the stock market's crashing. Remember, the stock market right now is very, very high. So what could go wrong? Do you guys remember 2008? Looks eerily similar to what we're seeing right now. People's homes are selling in a matter of hours. People are lining up multiple bids on a house. Stock market at all-time high. Doesn't that sound like late 2007? And then we saw the market crash, not only in real estate, but in the stock market in 2008. I'm not saying that's happening, but I'm going to tell you what, if it smells like it, it might be kind of like it. So keep your eyes posted for that. Again, if this is something that you want to talk about, go ahead and click on our chat box. I see we have a chat here. So you're saying you can't lose money in a fixed index annuity. Yeah, you can't lose money in a fixed index annuity based upon stock market. Okay. It cannot lose money in the stock market. Now, a simple comparison. So let's say you are like Mike and Dolores here in this picture. Now, I want you to look at the picture because they don't look too happy, right? Mike and Dolores have $5,000 a month income coming into their household from Social Security and the rest of their income, majority of the rest of their income from market-based resources like mutual funds. Suddenly, the market takes a major correction and their income has to abate from $5,000 down to $3,750. How do you think that makes them feel? And I guess the picture here is indicative of how they might feel. It has a negative impact. On the other hand, in this next picture, you're going to see a couple of smiling faces. This is Walt and Linda, same $5,000 a month coming in from Social Security, but the majority of their income is from principal protected assets. Stock market crashes, they don't really care. They're happy. Their income is still the same. You see, the stock market is not for everybody. It absolutely is not for everybody. A portion of your money should be in the stock market for liquidity reasons and for the ability to stave off the effects of inflation, okay? But here's a mathematical computation that I want you to take a look at, and here's why I say the stock market really isn't for everybody. And I don't care who you are, to have all of your eggs in one basket in the stock market is not a good idea. So I'll ask you this question. When does minus 30 plus 43 equal 0? When does minus 30 plus 43 equal 0? And this is a question that I ask at every college class that I teach, and people kind of look at that and they go, what's he getting at here? And it's not rocket science, but it's amazing how this mathematical equation escapes very bright people. So I'm going to assume that you guys are very bright people, and I want you to take a look at this, okay? If you have, for instance, $1 million in your retirement nest egg, your retirement account, and you retire, or maybe you're getting close to retiring, all right? You haven't retired yet. I'll give you both examples. But if you have $1 million in your account, and let's say 2021 turns out to be a bad year and the stock market loses 30%. We've seen that happen as recently as 2008. So let's say we lose 30%. Well, how much money do we have January 1st, 2022? Well, if you lost 30% on $1 million, you now start the new year with $700,000, right? So here's the question that I ask the students in the college classes that we teach. If you lost 30% in 2021 and the stock market, you're still in the stock market in 2022. How much do you have to make in 2022 to get back whole and or to par? And so somebody on our earlier call today, it was kind of funny. They said, well, this isn't golf, Winston. And I said, you got that right. Because in golf, if we're on the 10th hole and we're at par and we lose a stroke because we get a bogey, well, all we got to do on the next hole is get a birdie and we're back to par, right? But in the financial world, if you lose 30% of your wealth in 1 year, if you make, and what most people will say is, hey, Winston, I got to make 30% back the next year if I lost 30% this year. So let's apply that. So the next year, in the second year, we make 30%. Well, look at your account value. It's only at $910,000 because 30% of 700,000 is 210,000, right? 7 times 3 is 21. So we don't make 30% and get back to whole. We have to actually make 43% to get you back to $1,000. Now, this is for the folks that haven't retired yet. Imagine if all of your money is in the market and you're drawing an income from that $1 million account. And this is a question I'll ask people a lot of times. I say, if you got $1 million in the account, how much do you think you could take each year and not really worry about running out of money? And we get all kinds of answers. As a matter of fact, in the earlier webinar, someone said that they think they could take 10% of $1 million portfolio. That's $100,000 a year. And that person and I had a conversation after the webinar was over with, and that was a very unrealistic expectation. So if you're drawing an income at the same time the market pulls back, you got a real problem. And in the aviation term, we call that getting behind the power curve. You're never going to come out of that stall, and it's probably going to lead to a crash, a personal crash, and we want to avoid that. So again, I want to encourage you to click on our link in the chat and schedule a time to visit with us if this is something that you think you want to know a little bit more about and how to protect your own portfolio. So the fact of the matter is, there are some rules of thumb that people need to pay attention to while they're investing. And one of the most prevalent rules of thumb is the rule of 100, rule of thumb. It's not a physical manifestation like the previous rule was, but it is a rule of thumb because it kind of universally applies to people. And here's how it works. You simply take the number 100 and you subtract your age. So let's say you're 70 years old. 100 minus 70 will give you 30. And what that's telling you as a rule of thumb, if you're 70 years old, you should have no more than 30% of your investment portfolio in the stock market. Simple as that. Why? Because the older you get, the less time you have to recover meaningfully from a market crash or correction. All right. Any questions on this to this point? I don't see any new questions popping up on the radar screen, so I'm going to move on. I think that's pretty self-explanatory. What kind of plan will fit your situation? And that's where here at Winston and Companies, we think we do a great job with our flight plan because we tailor our planning strategies to what it is that you are trying to accomplish. You see those 3 people that were referred to us. 2 of them were with Wells Fargo Advisors, and the other one was with Fidelity Investments. And they both said, we have a plan with our financial advisor at Wells Fargo Advisors and at Fidelity. I said, well, let's see the plan. And you know what it was? It was a statement of a bunch of mutual funds that, it's funny, the ones that the Fidelity account had a bunch of Fidelity mutual funds, and the Wells Fargo Advisors account had a bunch of proprietary Wells Fargo accounts and mutual funds in it. So the people did not really have a plan. They just were sold a bunch of funds by the issuing company. So those are like the most expensive portfolios you can own. And what we want to encourage you to do is, if you have not had your investment portfolio stress tested like these folks, it was a really eye-opening experience. They were like, wow, we did a risk profile questionnaire on them to determine their risk now because they're at retirement age. And because we haven't gotten to the next meeting with these folks yet, these new referral people. But the funny thing is they're really excited about seeing what comes back, because in previous cases we had people that had put money in strategically invested assets into their 401k plan. There's dollars in that 401k plan that they put in there 20, 30 years ago. Okay, it's kind of like the rings of a tree, right? You cut a tree in half and you look at the earlier rings of the tree and you see how the thing aged. Well, they had money in there that had invested 20, 30 years ago. That's called strategic investing. They never harvested that money. But the fact of the matter is, when they were putting that money in there, their risk tolerance was much more aggressive than that of the 65-year-olds that they are now. So it's going to really be a telling story. The thing is, have you had your investment portfolio stress tested? I am a Series 65 licensed investment advisor representative with Brookstone Capital Management. We use TD Ameritrade Institutional as our custodian. And it is incumbent. It's part of the fiduciary process that we do this stress test. And I want you to know that we will act in your best interest. Do you currently have a written retirement income plan in place? So going back to those folks that showed up with Wells Fargo Advisor and with Fidelity, I said, let's see your plan. They put out a statement, okay, of their mutual fund holdings and their IRAs, their 401ks, their Roth. Okay. And nobody ever has any money in the Roth. They have a Roth, but it's always the minority account. And that's because they got bad tax advice. They were told, put money into the before tax one so you can get a tax deduction this year. All right. But I said, where's the written plan? No, we don't have a plan. This is our plan. I said, this is no plan. Where's the income section of this? Excuse me. Where's the income section of this? I see the investment section. Where's the tax efficiency strategy planning? Where's the Medicare inclusion and how we sign up for Medicare and how we bridge the gaps in Medicare A/B coverage? Where's the talk about legacy? Where's the wills? Where's the trust? None of that stuff. So our competitors at these big wirehouses, in this instance, Fidelity and Wells Fargo Advisor, nothing. All they talk to the people about is trying to make more money. And the fact of the matter is, when you get into retirement, it's not about how much money you make. It is absolutely not about how much money you make. It's all about how much money you keep. That's what really matters. And I want this to be the best segue possible into our retirement flight plan. Okay. Now, those of you who know me know that I've been a pilot since 1985. Got, many, many hours under my belt. And the flight plan was born one day when I was literally filling out an FAA flight plan. It's something that we do as an aviator when we're going from point A to point B. We fill out a flight plan, and it covers all of the aspects of the flight. How many souls are on board, what kind of equipment we're flying, what's the fuel burn of the engines of the equipment that we're flying, what's our duration and time in flight, what's the weather, the whole 9 yards. It even includes who we call if we should happen to go down. Okay? So it can come out looking for us, send out the Civil Air Patrol. The bottom line is, I said, this is exactly what we need to do to conclude a safe flight, but this is what our clients need to do as well in order to help assure a far greater likelihood of success of their retirement journey. So I want you to reference this picture. This looks like a picture of Sky Harbor Airport about 6 months ago. There was nobody in the place, right? But imagine, I was in the airport the other day. Things are coming back. Matter of fact, my son and I are flying to Nashville next week, and kind of looking forward to traveling again. And we're going to go on the airlines. The thing is this: imagine if you walk down the terminal and you look for the monitor, to see where my American Airlines flight to Nashville is, what gate it's going out of. Oh, it's gate C20, and it leaves at 10 o'clock in the morning. And it's out of, it's on time. And then all of a sudden you look at a number and it says 50-50. And you say, yeah, I don't remember 50-50. That's a new column. What does the 50-50 mean? Oh, that's the 50% chance of arrival. You'd say, what? 50-50 chance of arrival? What? I want 100%. I know there's no such thing as 100%, but I want to have a real good belief that I'm getting there safe and sound, and my family is, and the whole bit. But that's exactly what people do on a day-to-day basis. They go off half-cocked into a 20, 30-year retirement. They spend more time planning a 2-week trip than they do a 30-year retirement. Think about that. Is that you? Because I hope it's not. And if it is, and that concerns you, reach out to us at Winston and Companies. Click on that link, schedule a time to talk about how we might be able to help you. In fact, if you go onto our website, in the upper left-hand corner, there's a little link that says our process. And I wrote that in there very purposefully because people become a little bit intimidated about meeting with a new advisor. It's an experience where you kind of expose yourself to a degree about what you have and what you've achieved in your working years, how much you've accumulated. But we need to know that stuff, and you really want to share that. If it's not with us, you want to share it with anybody. But I laid out the process so that you can know what to expect in working with us. And a lot of people have commented that was one of the greatest things we ever put out there because it really disarmed them and made them feel comfortable. So you get on the plane. And down the aisle comes the flight attendant, and she starts giving you the safety debriefing. Put your seatbelt on. If the masks fall, put it on your child before you put it on yourself. There's a flotation device underneath your seat. Here's how you put it on. Blow into the red handle if it doesn't inflate by itself. Why does the airline do that? Well, it's a requirement, first of all, from the FAA. Secondly, it's because it's their chance before the plane pushes back from the gate and they get out on the taxiway. It's their way of telling you what you need to do in a universally prescribed fashion so that in the event that there is an actual emergency, you don't have time. You don't have time to start telling people. So when you look out the window and you're at 32,000 feet and there's an emergency, that's not the time to start barking out the emergency procedures, okay? And as it is with your retirement, we want to make sure that before you even take flight, that you plan efficiently so that when you do get into the air, so to speak, with your retirement, that you have a real good expectation you're going to make it to your desired destination, okay? So what can you expect? When you look at our flight plan, you're going to see different numbers. You're going to see we use green for green money, that's safe money. We use red for money that's hot, money that's, potentially at risk in the stock market. We're going to show you, pie charts, that sort of stuff. You're gonna know if you have enough money, if you're seeing green or if you're seeing red. And one of the things we want to avoid is that little screen that just popped up down in the right-hand corner where you see the yellow and then the red. And this reminds me of a gentleman that we had at a seminar earlier on this year. He was a Coast Guard. Right down the hall from our office is the U.S. Coast Guard recruiting office. So this guy was on the call, and his job in the Coast Guard before he became a recruiter was he was a rescue swimmer. And he said, Winston, after being exposed to our system and our process, he said, you're so right. And he said, I can tell you you're so right that people that are planning for their retirement are not so different from people that we would encounter out on a private boat or on a yacht or something that was sinking. He said, he likened drowning to running out of money. And he says, drowning was never the worst part about drowning. The final act of drowning was never the worst part of drowning. He said it was the hours and the minutes and the seconds that led up to it. It was the mental torture. It was the struggle that people went through. And he says, I see a direct parallel to that if people get into retirement and they're fearful of running out of money, that it could be very tenuous. It can be very stressful. And we want to help people avoid that. So again, if you'll click on our link in the chat box, you could schedule a time to come and visit with us. And we'd love to have you in for a cup of coffee and go from there. It's one of these things that today we're starting to see more and more people in the office, and you're welcome to come down here. And if you want to wear a mask, you're welcome to do that. But we'd love to see you in person. So here's a couple offers to those of you that are new, that are on the call tonight. An awful lot of the majority of you on this webinar tonight are existing clients. You all received this, and so you know that it's true that you're going to get this. Our offers to you tonight is a tax analysis of your existing portfolio, where we will take a look at if you leave it alone and if you convert it to a tax-free. We like to talk about going from always taxable to never taxable. Now, if taxes remain the same, that's a great strategy. But what if taxes go up in the future? The Biden administration literally came out 2-3 days ago and announced that they are working on a plan to raise taxes. It was something that was promised in the campaign. Take it seriously. It's going to happen. It has to happen. With this COVID situation and the money that the government's been giving away to people in stimulus, the deficit is out of hand. Taxes must go up. So we'll do a tax analysis for you. We'll also show you how your qualified accounts might stack up during different circumstances. Qualified accounts, again, being IRAs, 401k plans, and the like. And then we'll show you some alternate approaches on different things that you could do, like conversion to a Roth, conversion to what we call a LERP. And the last thing that we'll do is we will offer to you, I'm just holding up the actual edition, a copy of our book, The No Compromise Retirement Plan. It's overcoming the compromises in your IRA to live a more secure retirement. Now, Marty Ruby, good friend of ours, he wrote the book. And I don't want to take credit for writing the book because I didn't write the book. Marty wrote the book. But I was given the good fortune of being asked to write the foreword to the book because of the work that we do with our clients in tax strategies and planning. And so that was quite an honor. And, you look at the back side of the book and there's Marty's mugshot and there's my mugshot. But you'll find it to be a fascinating book. Virtually every single client that read that book found it to be one of the most important pieces in their retirement planning. And a lot of people contributed it to their main reason why they came and chose to work with us here at Winston & Company. So we'd love to get you those 3 reports and that book. And these reports, are beautiful. Our flight plan is beautiful. It's very easily laid out. It's not a bunch of gobbledygook. It's very easy to understand. And, one of the things that people really like about it the best is that when you come in for a semi-annual or an annual review, after you're a client, it doesn't change. It doesn't just go away. Oh, we forgot about that. It's a track to run on for really the rest of your life. And you know what? Even after you're gone, it's a track for your family and your survivors to run on. And we're dealing with it right now. We had a sad situation happen over Christmas where we lost a client and the family was able to come in completely upset. They didn't know where anything was, but we had it all in the vault, the flight plan. And they became great believers at that point. So let us have a chance to show you what we can do for you. And that pretty much wraps up things for tonight. I hope you found this to be interesting. I hope you'll go onto our website. I hope you'll check us out. I hope you'll consider working with us. Listen, life is short. It really is. You don't know what tomorrow brings. So it really makes sense to do good planning. And we hope that we can be a part of that with you. Thanks for attending. I'm Winston Stevenson. We hope we get the chance to see you real soon. Thanks again for being here with us tonight. And I will look forward to hearing from you real soon. Take care now.